China is undergoing a major economic transition that's bringing about lower growth, making investors nervous about the world's second largest economy. For more, let's bring in Chi Lo, a senior economist of Greater China at BNP Paribas Investment Partners. And Chi, briefly set the stage for us and describe this transition in China and why it's dinging economic growth.
Well, put it simply, China is moving from an industrial push, investment-led kind of economy towards a surface-based, consumption-led economy. Now, that transitional stage is not going to be short. If you go through all systems, they all take 10 years or beyond. China is only probably 2 or 3 years into the process. And within this transitional period, things are very fluid. There will be joblessness arising because companies will go bankrupt. But then, on the other hand, the new economy, there will be a new setup, new startups. So this is a creative destruction process, and that's why it's volatile. Inherently, it's volatile. And then growth rate will actually come down from the high growth rate that we saw in the past going forward.
And could the slowdown in China spark a global recession like some investors were fearing so far this year?
I don't think so. I think the fear is a little exaggerated. Because what we've seen, the Chinese slowdown, is from double-digit, 12, 15% a year in the past 10, 15 years on average, now down to below 10%. And we are still looking at, 6.5%, 7% this year, going into next year. Now, even Chinese growth slides down towards 6% by the end of this decade, which is likely as the system matures. We are still looking at 6% growth, which is one of the highest growth rates in the world.
A lot of countries would love to have that kind of growth. But can we trust that these projections, these numbers coming out of China are accurate? Can we trust that?
Well, China has its fair share of emerging market data issues. Now, all markets have data issues. I don't think investors should dwell too much on this problem. A quick analogy is that developed markets have transparency. People trust the data. But as fund managers, probably we are wrong as many times as in the developed markets as we are wrong in China. So I think there are many other issues that we should be looking at in China. And there are data series that we can cross-check the data series that the government tells us.
So when we hear presidential candidates like Donald Trump say the U.S. is getting ripped off by China, I mean, is he onto something? Is that a fair criticism?
Well, I think that is a big dose of skepticism. Now, that argument, we've heard it over and over again some time ago, and there have been academic as well as market research showing that that's not really entirely the case. It depends on the perspective that you come from and how you looked at it. Now, what we see is that China has contributed to world growth, especially in recent years, up to 3 to 4 percentage points for global growth. And now the slowdown in China is actually sort of taking away some of the growth momentum for the world. We cannot really blame China for all the problems while ignoring China's contribution to growth of the world.
And Trump likes to talk about China's currency, the renminbi.
Yes.
Talk a little bit about that, because it seems like every week China is doing something to that currency, devaluing it or removing the peg to the dollar.
I think what China is doing is not really devaluing or pushing it up on purpose. Since August last year, the PBOC, the central bank in China, People's Bank of China, has made the renminbi closer to market influence. So whatever the market does to the currency, it will show up now more than it had been before. So the trend that we've seen in RMB with downward pressure, it comes out of the natural economic forces as well. There's more capital outflow from China than capital inflow, putting downward pressure on the currency. People are nervous about China, so they are not that confident in investing, so there's not much capital inflow. Now, consider the day that global sentiment turns positive towards China, capital goes back in, and then China is still supported by the world's largest current account surplus. The RMB can go back up, so there's volatility. There's no one-way bet.
All right, Chi Lo, we'll be watching this. From Chi Lo from BNP Paribas, thanks very much for coming in.
Pleasure.
I'm Scott Gamm, and you're watching The Street.